Hello, everybody, and welcome to Commodity Culture, where our goal is to make you a better investor in the commodity space. My name is Jesse Day, and today I am joined by Adrian Day. No relation, but I wish he were my dad, and we are going to be drawing on his decades of expertise in the precious metals sector to get his current thoughts on gold and silver, both the metals and the miners, and we'll be honing in on where he's currently seeing value in the gold and silver mining space, along with getting his thoughts on where he's looking for value outside of gold and silver in today's financial markets. I'm very excited to bring you my conversation with Adrian Day. Let's start the conversation today with your current thoughts on the gold market. Obviously, very exciting times. We saw new all-time highs breached, a little bit of a pullback, but gold climbing up once again as we record this on October the 24th. Seems like very exciting times for the gold market. I had Dave Collum on the show recently, and he said that gold has him feeling irrationally exuberant. And so perhaps he says he usually gets slapped around when that happens. And so perhaps a correction is on the way, a little bit of a more significant correction than we've seen yesterday. What are your thoughts here on the gold market?
Gosh, good morning, Jesse. That's a huge question. I'll take the two parts. I'll talk about the gold market, and then we'll address Dave's comment on a correction. Well, let's do that one first. I mean, clearly, markets never move up in a straight line. We all know that. And like a lot of people, I've been nervously awaiting a pullback for a few weeks now. Even a month ago, we could say with the Fed's rate cut in the rear mirror, that was old news. With some stronger economic news, perhaps a pause. I mean, perhaps a skip of a meeting with another rate cut. And after having moved up so much, it's sort of understandable to think we might get a correction. And I still am looking for one. What I will say, however, is that the pullbacks in gold so far have been very short and shallow. Gold has been remarkably resilient. Sometimes it'll be down in Europe and then it goes up in the US. We don't even have to wait a day or two before we get the bounce back. So I don't think we should be, as an investor, as a person who manages other people's money, I don't think we should be surprised if at some point we get a pullback more meaningful than we've seen. Let's look broadly. Over the last 2 years, as we know, gold has moved up very, very strongly. Initially, it moved without the stocks moving at first, without participation from Western investors for the longest time. It was moving up because of central bank buying, number one, Chinese consumer buying, number two, which starts, central bank buying has been the last 2 years. Chinese buying has really stepped up since January. Now, both of those two, you could say we might get a pullback. I mean, we know why central banks are buying. It's because of a weaponization of the dollar, but they're also diversifying their assets. And so if a central bank says, well, we're now at 10% gold, they might say, well, we can afford to be a little more relaxed about buying more. So it would be natural if you got some kind of slowing of central bank buying. I will say this, however, that when China paused, as you know, in May, they haven't bought June, July, August, or September. And that didn't do much to central bank buying, but central bank buying is very, very broadly based. As for Chinese consumers, they were buying gold because they're nervous about the economy, but they're also nervous about the banking system. They're nervous about the stock market. They're nervous about the real estate market, and they can't buy crypto. So what are they left with? They're left with gold. But now the stock market in China, as you know, in the last month, has staged a remarkable rally. And of course, the time to be buying is when things are low. But if you're an investor that's seen your market for 2 years just slide consistently down 40%, you don't really look at the stock market as a safe haven. But now that it's rallied, I think you could see some Chinese buying switch from gold into stocks. So that's a kind of, sorry, I'm going on a bit about this, but what I'm trying to say is that there are reasons to think that some of the buying that we've seen may pause. But my own view is that any pullback we get is going to be very shallow and very short-lived, because the fundamental reasons that gold has been going up, the fundamental reasons that people have been buying gold have not gone away. Central banks are still worried about the weaponization of the dollar, and that is, if anything, going to increase over the next few years, not decrease. Chinese consumers are still worried about the economy and the banking system, so we'll still get support. And the last thing I'll say on this is I have a bit of a, let's say, different view, or I have a view on the gold market. I see the last 2 years, from really October of 2022 all the way through to the end of August, I see that as a run-up in gold and also silver and gold stocks, unrelated to the normal reasons that gold moves. In other words, the macroeconomic environment that normally drives gold was completely missing. You had high interest rates, you had low and declining inflation, and I'll say seemingly, you had a seemingly strong economy, you had a strong stock market, a reasonably strong dollar. That is precisely the wrong environment for gold to be going up. So what we saw for 2 years was really something completely different. People were buying for completely different reasons. Now, starting last month, we are beginning to move into that economic environment with the Fed having its first rate cut, and it's the first of many, or several at any rate, and clear cracks appearing in the US economy, the dollar declining. We're now moving into an environment that is actually an environment where gold should move. So I would say that if you like, the normal gold bull market has only just begun.
Hey guys, just a quick break to hear from today's sponsor, ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. I do want to kind of pull on that thread when you mentioned the Fed cutting rates 50 basis points with more rate cuts ahead. We've heard time and time again from a variety of analysts that when the Fed starts cutting rates, that is when we're really going to see rocket fuel injected into the gold sector and into the gold price. There appears to be somewhat of a global rate cutting cycle going on. The Bank of Canada, I believe, has now cut 50 basis points in their last meeting. The EU, China, etc. How significant do you see this for the gold price moving forward? Obviously, these have lagging effects. It's not like the Fed just cuts 50 basis points and suddenly gold takes off. But as the market digests the fact that we're in a rate cutting cycle, how do you expect that to affect gold?
No, well, absolutely. If you look back to every rate cutting cycle after the Volcker era, let's say, so after Volcker had conquered inflation, and then obviously the Fed started reducing rates at that point. But after that, every single time the Fed first cuts rates after a rate hiking cycle, we see gold move up. And that is, I mean, that's logical. but it's also empirically true. Um, and so that's what we've seen. And that's why I say that, this is really just the beginning of the gold bull market. And we haven't talked about stocks much, but we can in a minute. But the key is that when Volcker, raised rates on the Treasury bill to almost 20% and then started cutting rates, he had conquered inflation. He had moved rates well above the prevailing rate of inflation and killed it. What we're seeing now, and what we've seen for the last, 10 or 20 years, is that the Fed and other central banks do not go far enough, and they stop before they've conquered inflation. So if you look where we are right now, the Fed's preferred measure of inflation, the core PCE, for people who don't eat and don't drive and don't heat their homes, but the core PCE is their preferred measure. So even if you use their preferred measure, you look at the last 5 months, it's been it's plateaued, it's stable, it's not coming down anymore. Well, at 2.6, 2.7, 2.8, we are well above, that's significantly above that arbitrary 2% target. It's also importantly well above where we were before COVID. So they have not yet killed inflation. And as for globally, the IMF this year, the International Monetary Fund this year, puts global inflation at 5.9%. That's 3 times this arbitrary target that all the central banks of the world seem to be using. So the point is they're cutting rates before they've killed inflation. And that is just the most bullish environment for gold that you can think of.
I want to touch on silver here as well. Obviously, silver bulls getting pretty excited as we're currently at $33 and change. Silver recently reaching levels not seen since 12 years ago. A lot of people believing that this is the moment where we could see silver move to previous all-time highs. So many commentators have been throwing around the figure of $50 silver for a while now. Perhaps a little hyperbolic. I don't think it will just take off like that, but some believe that when silver moves, it can move exceptionally fast. And indeed, in the past, it has. I'm wondering what your current thoughts are on the silver market and if that $50 price target is reasonable over the course of the next year or so.
Yeah. Well, first of all, I'm very bullish on silver. Uh, whether it's $50 or not, I mean, I think we should remember that the previous peaks of silver, both in 2011 and then back in the with the Hunt brothers, were sort of had their own peculiar circumstances around them. So whether we get to $50 anytime soon on this run or not, I'm not sure, but I'm certainly bullish. And there's several reasons to be bullish on silver. I mean, we all know that we all know there's finally, I should say, there's a supply demand deficit. And honestly, ever since I got into the business for 40 years, every year the silver bulls will say, well, there's going to be a deficit, but it never seemed to happen. But I truly think that this year, last year, there is a structural deficit at this price. Now, of course, deficits get reversed by higher prices. That's number one. Number two is it's different from gold in many ways. There are no huge above ground stockpiles of silver just ready to flood the market. The third important factor, everybody knows, that silver has more industrial uses. We know that. But I think what's very important now, of course, is the huge and growing demand from solar. And I don't think that's going to go away. I'm a skeptic on this whole green energy business with windmills that violate the beauty of the countryside and kill birds and so on, and in fact use more minerals. And if you go from cradle to grave, one of those huge windmills uses more minerals and more carbon emissions, more fossil fuels in making the darn things than if we just use fossil fuels for the energy. But anyway, that's a different issue. But I think solar is clearly something different. I mean, it's clearly a legitimate in certain areas, not really in the north of England or in Germany, but it's certainly legitimate in a lot of areas. Where I am in Puerto Rico, we should be using far more solar than we are. And I don't think that's going to go away. And as solar becomes more efficient, I have a different view on this than a lot of people. We may, in fact, see each solar unit use a little less silver. More importantly, they will last longer, so they won't have to be replaced so often. But more people will be using solar, no question. So that's really significant. On the demand side, what's on the supply side, rather, on the supply side, what is truly significant that a lot of people haven't really grasped is that silver is not only different from gold, but it's also today different from how it was 30, 40 years ago. 40 years ago, about 80% of silver came from primary silver mines. Today, at most 70%, at most 30% comes from primary mines and 70% is a byproduct. Now, if you exclude the byproduct that comes from gold silver mines, right, which is part of that 30%, incidentally, you're left with silver that is a byproduct of copper, byproduct of zinc, byproduct of lead. Now, if you have a lead mine in Bolivia, where 10% of your revenue comes from silver, you don't increase your lead production, you don't do an expansion, you don't build a new lead mine because the price of silver moves up. And so the point I'm making is because most silver is byproduct and is typically a small component of a base metal mine, the supply of silver is not responsive to changes in the price of silver. And that's true on the downside as well as the upside, which is why when silver collapses, you get this oversupply and it just feeds on itself. But when the price of silver moves up, you don't get an increase in supply, which means that the price exaggerated. And that's really one of the reasons why you have these exaggerated moves, I'll say exaggerated, but why you have these very strong moves in silver. So, and also, of course, the investment demand, what I'll call the retail speculative investment demand is far more important in silver than it is in gold. And so, yeah, I think we can easily see a very sharp move. We've already seen a sharp move, but we can easily see, silver will get to $50 before gold gets to 6,000. Let's put it that way, or 5,000.
I want to touch on the miners in just a moment, but first I want to get your thoughts on the BRICS Summit in Kazan, Russia, wrapping up probably about right now as we speak. There was no big announcement of a gold-backed currency as many gold bulls online were hoping for. It was pretty funny because yesterday trending on Twitter was BRICS unveils currency, and I was like, what? It happened? And I clicked and it's like Putin holding some mock bill that somebody made of like with all the BRICS nations. I'm like, what is going on here? Now they do want to establish more trade between them outside of the US dollar. They're talking about an alternate payment system. Some have their doubts that these countries will ever be able to fully agree enough to be able to find some alternative and cooperate. Jim O'Neill, former chief economist of Goldman Sachs, recently was quoted on the BBC as saying, China and India are doing their best to avoid wanting to attack each other a lot of the time. Trying to get them to really cooperate on economic things is a never-ending challenge. Now, shortly after this article was published, Xi Jinping and Modi sat down together and hashed out an agreement to stop attacking each other and to cooperate. So very interesting there. I'm wondering what your thoughts are on that and on just the general direction of the BRICS nations at this point? Do you think this is going to be a big disappointment that no gold-backed currency was announced? Obviously, this feels like something. What is your thoughts on an alternate payment system outside the U.S. dollar backed by gold? This could be decades away, right?
Yeah, well, lots of thoughts there. Look, when I think of this, I always think of that overused comment of Hemingway about how you go bankrupt slowly at first and then suddenly, and that's what will happen with an alternate payment system. That's how the U.S. dollar, in my view, will lose its reserve status. Now, is the latter, the U.S. losing its reserve status, going to happen overnight or next year or the year after? No, it's not. But the US, if you look at both the payments and you also look at, the payments and also how trade is paid for, 40 years ago, it was maybe 95% was in dollars. Now that's come down significantly, but still the overwhelming majority of world trade is in dollars. But they're chipping away at the margin. And if you get Saudi Arabia and, as we saw, Saudi Arabia and China agreeing to do the oil in other currencies, that's very, very meaningful. So all these things are chipping away at the dollar's dominance at the margin. The other part of the equation, of course, is the dollar as a reserve currency, not just its use in trade, but as a reserve. Well, again, in the 1990s, something like 75% of central bank foreign reserves were in the dollar. Foreign reserves meaning not the currency of the country itself. So in terms of German central bank, we're not talking about the euro. In Britain, we're not talking about the pound. So foreign reserves, 75% was in dollars. That number's now down to barely above 50%. So there's already over the decades, it's stepped up in the last few years with the weaponization of the dollar and the huge twin deficits in the US. We could go on about the problems in the US for a long time, but foreigners see these problems and want to diversify away from the dollar. So now we're barely above 50%. So you've got the payments and you've got the reserve, and the dollar is slowly losing its overwhelming dominance. It's still the most dominant currency without a shadow of doubt. And until there is a well-established alternative, it's certainly going to remain the world's reserve currency. But again, as Hemingway said, slowly at first and then suddenly. I think once you get under 50% of reserves, foreign reserves in the dollar, once you get, 50% of the trade in currencies other than the dollar, then the dollar starts to lose its dominance very, very quickly. So yeah, there'll be some disappointment if something didn't happen, but if I can say this, an awful lot of the stuff I've seen over the last few months, mark your calendars, October the 24th, sign up here for my special bulletin alert for $1,000 a year. It's just a way to get people to buy subscriptions, frankly. And people should be a little more skeptical of some of these things. It will happen. It will happen. If there were an obvious alternative right now, I think the US would already be well on the way to losing its reserve status. I think I'm from Britain, as you may have been able to tell. And, the British pound was the world's reserve currency, backed by Britain's military, economic, and political power, dominance for, 120, 30, 40 years, whenever you measure it. But in the case of Britain, it was very, very obvious as early as the 1920s and 1930s. It was very, very obvious that the US was the up and coming economic and military power. And obviously during the Second World War, they cemented that dominance. And so it was very, very obvious. And so the transition from the pound to the dollar happened fairly smoothly and without a war between those two nations. Although you guys, not you, you're Canadian, but those guys didn't like us trying to take back the Suez Canal. But normally when one country when one country challenges the other's dominance, normally those two countries go to war. You saw it with Britain and France, at the beginning of the 19th century. You saw it with Spain and the Netherlands earlier than that. So, but Britain and America didn't go to war. There is no obvious alternative right now. And until there is an obvious alternative, I think the US is going to remain dominant.
Well, I want to shift to the gold mining space now and read you a tweet made by your associate at Euro Pacific Asset Management and frequent guest of this show, Mr. Peter Schiff. He said,
I hope you agree with him.
He said, today, despite reporting its biggest quarterly profit in 5 years, nearly a six-fold year-over-year increase, on track to report the largest annual profit in its over 100-year history, Newmont is down 11%, wiping out the last 2 months of gains, despite an 8.5% rise in the price of gold. What are your thoughts on Newmont dropping 11% in a single day after releasing its earnings report? And do you think, and just as a follow-up, do you think there's still opportunity in many of the big producers when it comes to the gold mining space?
Yeah. Well, first of all, of course, their production was up because they merged with Newcrest, and their cash flow is up because the price of gold is up, and they merged with Newcrest. What hurt Newmont, of course, was their costs were up. Their costs were up much more than analysts were expecting. So their all-in sustaining costs, don't quote me on this, came in at around $1,640, and that's almost $200 above what the analysts were expecting. So that's a huge shock. I'll be honest, Newmont has not been one of my favorite companies for a while. It still is not one of my favorite among the big cap stocks, and so I'm not intimately familiar with all of the details. But it was definitely the costs that hurt them. In answer to your second question, is there still opportunity in the big cap miners? Absolutely, yes, without a shadow of doubt. I'll get back to my thesis, if you like. Well, thesis is a bit pretentious. My theme is that what we've seen for the last 2 years is just like a sort of overture before the curtain goes up and the opera begins. The Fed cutting rates was when I marked the beginning of a normal bull market for gold and for gold stocks and for silver. And so in that context, it has only just begun. You look at, let's look at Agnico Eagle, for example, the third large, and the stocks are cheap, sorry, the stocks are still undervalued. You look at Agnico Eagle, the third largest of the big cap miners, its price to cash flow this quarter, it hasn't reported yet, it'll report next week, but is expected to be about 7.5 times, the price of 7.5 times cash flow. That is in the bottom decile of their 40-year history. Now, normally when the price of gold goes up, multiples expand, right? But you're seeing Agnico not only not expanding, but trading near the bottom of its price to cash flow that it ever has done. Look at Barrick, the number 2 gold mining company. You look at Barrick on a price to net asset value. Again, it's trading in the lowest decile of its entire history. Now, people will say, oh, it's got Pakistan, it's got, Zambia and Mali. And that's why I first pointed out Agnico, which has no particular challenges like that. But the big cap stocks remain undervalued. That's the important thing for people to understand. Their prices are down, not Agnico, but the others, their prices are down, like Barrick at $21, under $21. I mean, it was $30 just 2 years ago. It was $50 10 years ago. And it's a better company today. Doesn't have debt. It doesn't have hedges. Um, uh, when I say it doesn't have debt, its net debt is neutral. Net debt is neutral. It has debt, but it also has cash, just to be clear. And so the prices are way down, but more importantly than the price, the values are just really astonishing. So yeah, I remain very, very optimistic on the big cap stocks. And again, the other thing that I'll mention is that normally at the beginning of a bull market, as we know, the stocks outperform the metal tremendously. Now, I'm sure you've heard a lot of people say, why are the stocks lagging and what's wrong with the stocks? Well, first of all, I say when the XAU, which are the big cap stocks, when they're up 30% this year to date, that's not too bad, right? Let's not complain about 30% in 10 months, 9 months. But the leverage you see at the beginning of a bull market, normally the gold stocks outperform gold dramatically after gold bottoms. So in 2000, for example, in the first 3 months, gold was up like 6%. The gold stocks were up 100%, more or less. And you can see that in 2009 as well, and so on. So normally at the beginning of the bull market, the gold stocks well outperformed, and they haven't. For the last 6 months, the gold stocks and gold are up. Gold stocks are up a little bit more, but not dramatically more. But again, that goes back to my thesis that this traditional gold market has only just begun. I bet you if we look at the end of this year, we will see from the point of the Fed's rate cut until the end of this year, I bet you the gold stocks will well outperform gold in that period. So yeah, the gold stocks, the major stocks, still have a long way to go.
And stepping outside of the gold and silver space, are there any other areas of the market that you think are presenting value at the moment, whether that's other commodities or sectors outside the commodity space?
Well, I said in the commodity space, I certainly like copper. We all know the huge demand growth that is expected from copper for electrification, not just electric vehicles, but electrification in general, which uses a lot more copper. This is part of a green irony, right? But it uses much more copper than, say, the internal combustion engine or a gas-fired plant, and so on. So the demand for copper is going to grow meaningfully. And even if the expectations for copper demand growth are only half as much as people are expecting, we still simply will not have the copper to fulfill that demand. And the interesting thing about copper, we always complain as investors about how long it takes from discovery to production, even from a feasibility study to production. It can take 5, 10, 15 years for a copper mine because they're huge mines. But the flip side of that is actually a positive. It means as analysts and investors, we can look ahead with a fair degree of confidence in the possible production 5 years from now. And I will say with almost certainty, there is no copper, no meaningful source of copper in 5 years' time that we do not already know about. And so you can predict what the potential copper supply in 5 years' time will be if everything goes smoothly, and it never does, of course. And it simply isn't enough to meet the demand. So copper, I'm very, very bullish on a 3, 5, 10-year horizon. Outside of resources, we're looking, I guess there's a couple of areas that are attractive. First of all, among the bigger markets, I think the British market, the UK market is perhaps the most attractive of the major markets. It's very weak. It's been weak for a while. the stocks there tend to have good dividends, so you can get 4 or 5% dividend yield on a lot of very, very good companies. And of course, the stock market is a little soft right now because of the new Labour government and their plans for increasing taxes and just generally concern about that government. We're buying sort of selectively in Japan as well, because I think as Japan raises rates, normally raising rates is bad for an economy, bad for stocks. But in the case of Japan, when they raise rates after being at negative rates for so long, a lot of the money in Japan, institutional money that went outside of a country, is coming back into Japan. So, a Japanese institution can still get more money in a US T-bill than in a Japanese equivalent, but everything happens at the margin, as I keep saying. And as the Fed lowers rates and the Japanese Bank of Japan raises rates, the differential starts to go away, and the currency risk then becomes sort of meaningful. When you can get 5% here and nothing in Japan, well, the currency risk is worth taking. When you can get 4% here and 1.5% in Japan, then you think twice about the currency risk. So money will move back in Japan. And as money moves back in Japan, then it'll strengthen the yen, which is good for foreign investors. And some of that money will go into JGBs, of course, but some of that money will go into the Japanese stock market. So we are buying the Japanese stock market. And then lastly, Hong Kong, China. I don't buy stocks that only trade in China, but I'll say Hong Kong stocks and China companies that trade in Hong Kong remain exceptionally good value on a fundamental basis relative to the rest of the world. They do, of course, have one huge risk, the conflict between the West and China could come to a boil at any time. So I wouldn't go overboard, but the stocks are just remarkable value. I mean, we have stocks on our portfolio. We have stocks here that are trading at 10% of NAV with no debt. We have stocks that are trading at 3 times earnings, and 3 times cash flow. So the stocks are very, very cheap, a lot of them, and they pay good dividends. So we're buying Hong Kong, China as well.
And any thoughts on emerging markets? I spoke to Michael Pinto recently. He was very bullish on India. I've spoken to a few people who were of a similar sentiment. Some people have brought up Argentina on the show, Brazil. I'm wondering what your thoughts are on the emerging markets. Anywhere there you're seeing value? And also as a side question, emerging market debt. Now that we're seeing rate cuts and people getting lower rates on T-bills, people are going to go perhaps in other areas to find yield, and emerging market debt has a higher yield. What are your thoughts there?
Yeah, no, I think that the second part, I'll deal with the second part first. I think that's absolutely true. But in the scenario that I'm looking ahead and that's likely to happen, the equities are going to be better than the debt. So if you are a fixed income investor, then yes, it makes a lot of sense to start looking now at the emerging market debt. But if the scenario of stubborn inflation, lower dollar, if that's the scenario for the next while, then the emerging market equities will do much better. If you look at stagflationary periods, and that's what I think we're heading into, not necessarily runaway inflation, not necessarily a depression, but sluggish economic growth at best and stubborn inflation at best, that's stagflation by definition. And in stagflationary environments, gold is number 1, gold stocks is number 2, other commodities are number 3, emerging market equities are number 4, and emerging market debt is number 5 in terms of performance. So if history is a guide, the SEC always says, we have to say past performance is no guarantee of future success. Absolutely. But as Winston Churchill famously said, the past doesn't predict the future, but it's a good way to bet. And so, yes, emerging market equities tend to do well in environments where inflation is stubborn and rising and the dollar is falling. And so I guess the big question to me is or the big question is in a discussion is what's that definition of emerging market? Because, Hong Kong used to be called an emerging market. Singapore used to be called an emerging market, but I don't think we call them that anymore. So I prefer to talk about smaller markets because they're the ones that I most like. Emerging markets like Morocco, Saudi Arabia, I think there's tremendous opportunity in Saudi Arabia. I've looked at a lot of the stocks. None of the brokers I use can buy in that market. Same with Turkey. They can't buy on the Istanbul Exchange. So sometimes it's very difficult to buy emerging markets. And if you look at, let's say, Turkey, Argentina, I think the Turkish stocks are very good value now. But you look at Turkey, Argentina, Brazil, even Korea. I don't know if you want to call South Korea emerging or not. Its stock market is emerging. The economy is not, but the stock market I would classify as an emerging market for various reasons we don't need to go into. But if you look at those markets, the number of stocks that trade outside of the local market, so for example, on the New York Stock Exchange or on NASDAQ, are just a handful in each market. And because of that, typically, they are not cheap. They are very, very expensive. So you look at Korea, for example, and the handful of Korean stocks that trade in the US are trading at multiples significantly more than even the best quality Korean companies that don't trade outside the market. Now, if Korea opens up its stock market to foreign investors, which, they've been talking about that for years now, but if they ever do, what you're going to see is a realignment of those valuations. And so the ones that trade over here are not going to zoom upwards because they've opened a market. They're going to fall because investors can buy other things. So I'm always very, very nervous about buying emerging market stocks on New York for that very reason. But we bought the Argentine stocks. There's a handful you can buy. So yeah, it varies country by country, frankly. But I do think the smaller markets, and that includes what we'll call emerging markets, are likely to be very, very strong for the next several years. Not only because the macroeconomic environment that I describe is a favorable one for those equities, but also, of course, many of them, particularly the commodity exporters, are going to have that extra boost from what I see as a strong commodity market.
Incredible insights there. That was great. Thank you so much. Tell us about Adrian Day Asset Management and Global Analyst for people who want to hear more from you.
Okay, well, I have two different businesses. The money management business, we manage discretionary accounts in global markets, and we do have dedicated accounts in gold and resources. All of our accounts are personalized, meaning a person can look for tax losses, not look for tax losses, want income, not want income, etc. In the gold, people can be aggressive or conservative. So we do that, and then the newsletter, which is a separate letter, a separate business. We have a small portfolio of stocks we recommend and follow, and so people can get information on both of those if they go to adrianday.com.
Great. Well, I'll put a link in the description below to adrianday.com. Yeah, so people can check that out. Thank you so much, Adrian, for coming on the show. Tons of knowledge shared, and I greatly appreciate it.
Well, thank you very much for having me, Jesse.
And thank you for joining us today. As a reminder, this episode was brought to you by ARC, silver, gold, osmium. For all your precious metals needs, head to arcsgo.com and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.